Friday, January 31st, 2026. Gold prices are falling, down 1.77% to $5,211 per ounce. Silver is dropping 2% to $111. Platinum and palladium are getting crushed, red across the board. But here's what the headlines aren't telling you. Despite Friday's sell-off, gold just posted its strongest monthly gain since January 1980. Not 2020, not 2008, not the 1970s inflation crisis. We have to go back 46 years to find a monthly gain comparable to what just happened. Gold climbed over 20% in January. That's roughly $1,000 per ounce in a single month. Silver surged 56%, on track for its best monthly performance in recorded history. And then Friday hits. Trump announces he's about to name a new Federal Reserve chair. Rumors swirl that it's Kevin Warsh, known as a monetary hawk, and suddenly, the safest of safe haven assets starts falling while everyone's watching. The question isn't why gold fell on Friday. The question is, what the hell happened in January that made gold gain $1,000 in 30 days? And is this the beginning of a new era or the peak before a spectacular crash? Today, we're decoding the most violent precious metals rally in nearly half a century, exposing what's really driving it and revealing what Trump's Fed chair pick could mean for the future of gold. Charters, the January moonshot. Let's start with the sheer magnitude of what just happened. Gold began January somewhere around $4,200 per ounce. By Thursday, January 30th, it touched an all-time record high of $5,594.82. That's a gain of over $1,400 at the peak, roughly 33% in 1 month. Even with Friday's pullback to $5,211, the monthly gain is still over 20%. To put that in perspective, gold's average annual return over the past 2 decades is somewhere around 10%. We just got double that in 1 month. Silver's move was even more extreme. It hit a record high of $121.64 on Thursday, up 56% for the month. That's not just the best monthly performance of 2026 or 2025. That's potentially the best monthly performance for silver in modern history. This isn't normal price discovery. This is panic buying. But panic buying of what? And by whom? The perfect storm. 6 drivers. January 2026 created a perfect storm for precious metals. 6 major factors converged simultaneously, each one powerful enough to move markets on its own, all hitting at once. Driver 1. Geopolitical chaos. The world is more unstable than it's been in decades. U.S.-China tensions are escalating. The Middle East is a powder keg. Russia-Ukraine remains unresolved. Trade wars are intensifying. When geopolitical risk spikes, capital flees to safety. And despite all the modern alternatives, cryptocurrencies, bonds, real estate, nothing has the 5,000-year track record of gold as the ultimate store of value during chaos. Institutional investors, sovereign wealth funds, central banks, they all started piling into physical gold as a hedge against geopolitical catastrophe. Driver 2. The dollar collapse. Here's where it gets interesting. Normally, gold and the dollar move inversely. Strong dollar, weak gold. Weak dollar, strong gold. In January, the dollar experienced a steep slide, driven by mounting concerns over U.S. fiscal stability. The U.S. debt is now over $36 trillion and climbing. Deficits are structural. There's no political will to cut spending or raise taxes. The world is watching the United States spiral into fiscal crisis. And the response has been brutal. Sell dollars, buy hard assets. A weaker dollar makes gold cheaper for international buyers, which increases demand and drives prices higher. But it's more than just the exchange rate effect. The dollar's decline reflects a loss of confidence in U.S. fiscal management. When the world's reserve currency shows cracks, people buy gold. Lots of it. Driver 3. Fed interest rate uncertainty. The Federal Reserve kept interest rates unchanged in their January meeting, as expected, but the uncertainty around future policy is extreme. Markets are pricing in 2 rate cuts in 2026, but inflation hasn't been definitively defeated. The economy is showing mixed signals. The Fed is navigating between recession risk and inflation risk with no clear path forward. Interest rate uncertainty is gold's best friend. When people don't know whether rates are going up or down, whether the economy will boom or bust, they buy insurance. Gold is that insurance. Lower interest rates make gold more attractive because gold doesn't pay interest. When treasury yields are low, the opportunity cost of holding gold shrinks. When rate cuts are expected, gold rallies. Driver 4. Central bank buying. This one's flying under the radar, but it's massive. Central banks worldwide have been net buyers of gold for years, but the pace has intensified. China, Russia, India, Turkey, Poland, dozens of countries are accumulating gold reserves at record levels. They're not buying gold to speculate. They're buying it to reduce dependence on the dollar and diversify away from U.S. Treasury bonds. When central banks buy, they buy big, tons at a time. And they don't sell when prices rise. They hold. This creates a one-way bid under the gold market. Constant buying pressure with very little selling from the largest holders. Driver 5. Swiss gold flows to London. Here's a detail that tells you how intense the physical demand is. Gold shipments from Switzerland to the UK hit their highest level since August 2019. Why does this matter? Switzerland is the world's refining hub. The UK, specifically London, is home to the world's largest over-the-counter gold trading market. When refined gold flows from Switzerland to London in record amounts, it means physical demand in the trading hub is surging. People aren't just buying paper gold contracts. They're taking delivery of actual metal. This is what separates real demand from speculation. Physical flows confirm the rally is driven by genuine buyers who want the metal, not just traders flipping paper contracts. Driver 6. Asian institutional demand. The Hang Seng Gold ETF surged more than 9% in its Hong Kong trading debut. This is significant because it shows Asian institutional demand is exploding. Asian investors, particularly in China and Hong Kong, have deep cultural affinity for gold. But this isn't just retail buying gold jewelry. This is institutional capital flowing into gold ETFs for portfolio allocation. When Asian institutions pile into gold, they bring enormous capital. And unlike Western traders who might flip positions quickly, Asian gold buyers tend to be long-term holders. All 6 of these factors converged in January. Geopolitical chaos, dollar weakness, rate uncertainty, central bank buying, physical flows, and Asian institutional demand. The result? A $1,000 monthly gain in gold. Friday's reality check. So if everything was so bullish, why did gold fall on Friday? 2 words. Kevin Warsh. President Trump announced Thursday that he would unveil his choice to succeed Jerome Powell as Federal Reserve Chair on Friday. Speculation immediately centered on Kevin Warsh, a former Fed governor known for hawkish views on monetary policy. Hawkish means he favors higher interest rates to combat inflation, even at the risk of slowing economic growth. Why does this matter for gold? Higher interest rates make gold less attractive. When you can get 5% or 6% on treasury bonds, why hold gold that pays 0 interest? The mere speculation that Warsh might get the job was enough to pressure gold prices. Markets started pricing in the possibility of a more aggressive Fed, higher rates for longer, and a stronger dollar. Combined with profit-taking after a $1,000 monthly gain, gold fell nearly 5% at one point during Friday's session, before recovering slightly to close down 1.77%. But here's the critical question. Is this a minor correction or the beginning of a reversal? The UAE gold market, a local lens. Let's zoom in on the UAE gold market because it provides a useful lens on how these global moves play out locally. On Thursday, 24-karat gold in the UAE surged to AED 666 per gram. By Friday, it had fallen to AED 628.25, a decline of about AED 38 or roughly 5.7%. Similar moves played out across all gold purities. 22 karat, 21 karat, 18 karat, 14 karat all fell roughly AED 1 to AED 1.50 after Thursday's surge. What's interesting about the UAE market is its sensitivity to both global gold prices and local demand dynamics. The UAE is a major gold trading hub. Dubai's gold souk is legendary. Jewelry demand is cultural and constant. But UAE gold prices also reflect import premiums, VAT considerations, and currency factors, since the dirham is pegged to the dollar. Friday's decline in UAE gold rates mirrors the global move, But the magnitude of the Thursday surge and Friday pullback shows just how volatile things have become. For UAE consumers, this volatility creates both opportunity and risk. Buy on the dip, and you might catch a bargain. Buy at the peak, and you could see your purchase lose 5 to 10% of value in days. Jacques Cars, silver's even wilder ride. If gold's January was spectacular, silver's was absolutely insane. Silver hit an all-time record of 121.64 on Thursday. By Friday, it had fallen to 111.11, a decline of over 8.6% from the peak. But even with that drop, silver is still up 56% for the month. That's not a typo. 56% in 30 days. Why is silver moving even more violently than gold? 2 reasons. First, industrial demand. Silver isn't just a monetary metal. About 50–60% of silver consumption comes from industrial applications, solar panels, electric vehicles, electronics, 5G infrastructure. When industrial demand surges, perhaps driven by solar PV installations or EV production, silver prices explode because supply is relatively inelastic. You can't just turn on new silver mines overnight. Second, market size. The silver market is much smaller than gold. Total above-ground silver is worth a fraction of gold's value. This means it takes less capital to move silver prices dramatically. When investors pile into silver as a leveraged play on gold or as a bet on industrial demand, the price moves are much more violent than gold. Silver's 56% monthly gain reflects both its monetary role alongside gold and its industrial demand story. But the 8.6% Friday drop shows how quickly that narrative can reverse when sentiment shifts. The platinum and palladium collapse. Gold and silver grabbed the headlines, but platinum and palladium told their own dramatic story. Platinum hit a record high of $2,118.80 on Monday. By Friday, it had crashed to $2,512.41, a fall of nearly 14% from the peak and down 4.45% on Friday alone. Palladium dropped 4.24% on Friday to $1,120.95. Why did these metals get hit even harder than gold and silver? Because they're primarily industrial metals used in automotive catalytic converters and other applications. When economic uncertainty rises, industrial demand concerns outweigh safe haven appeal. If people fear a recession or slowdown in auto production, platinum and palladium demand collapses. The fact that platinum and palladium fell harder than gold on Friday suggests the sell-off was driven partly by industrial demand concerns, not just Fed chair speculation. This is important. It means the market is pricing in potential economic weakness, which should theoretically be bullish for gold as a safe haven. But it's bearish for industrial precious metals. What Kevin Warsh actually means. Let's talk about Kevin Warsh and what his potential appointment could mean for markets. Warsh served as a Federal Reserve governor from 2006 to 2011, spanning the financial crisis. He's known for several positions. Hawkish on inflation. Warsh has consistently argued that the Fed should prioritize fighting inflation even at the cost of economic growth. He was critical of the Fed's aggressive money printing during and after the financial crisis. Skeptical of QE. Warsh has questioned the effectiveness of quantitative easing and warned about its long-term consequences for asset bubbles and wealth inequality. Market-friendly but tough. He's seen as someone who understands markets, having worked in investment banking before joining the Fed, but who won't hesitate to tighten policy if inflation threatens. If Trump picks Warsh, the implications for gold are mixed. Bearish short-term. Higher interest rates make gold less attractive. A hawkish Fed chair could strengthen the dollar and reduce inflation expectations, both negative for gold. Bullish long-term. If aggressive tightening causes a recession or financial crisis, gold could rally as a safe haven. And Warsh's skepticism of QE might actually increase gold's appeal as an alternative to fiat currency. The market's Friday reaction, selling gold on Warsh speculation, reflects the short-term bearish view, but it might be missing the longer-term dynamics. The technical damage. Let's talk about what Friday's sell-off means technically for gold. Gold hit a record high Thursday, at $5,594.82. By Friday, it had fallen to as low as $5,100 intraday before recovering to close around $5,211. That's a drop of nearly $500 or about 9% from peak to trough. In technical analysis terms, that's significant. Key levels to watch. 5,200. This is roughly where gold closed Friday. If it holds above this level, the January uptrend remains intact. If it breaks below, the next support is around $5,000. $5,000 psychological level. Round numbers matter in trading psychology. If gold falls to $5,000, that could trigger more selling as stop-loss orders get hit. $4,800, $4,900 zone. This was resistance earlier in January before the final surge. It could now act as support if gold corrects deeper. From a momentum perspective, gold was massively overbought going into Friday. The Relative Strength Index, RSI, and other indicators were flashing extreme readings. A correction was due. The only question was, what would trigger it? Trump's Fed chair announcement provided the catalyst. Is this the top? Here's the question everyone's asking. Was Thursday's $5,594 high the top? Or is this just a healthy correction before another leg higher? The bull case for more upside. The fundamental drivers haven't changed. Geopolitical tensions aren't resolved. U.S. fiscal situation isn't improving. Central banks are still buying. Physical demand remains strong. A 20% monthly gain requires consolidation. Corrections are healthy and normal in bull markets. Pullbacks create new entry points for buyers who missed the initial surge. If gold holds above $5,200, the uptrend remains intact. New highs above $5,600 would confirm the bull market is continuing. The bear case for a reversal. A $1,000 monthly gain is unsustainable. It reflects panic buying and speculation, not sustainable demand. When moves become parabolic, reversals are equally violent. If Warsh becomes Fed chair and implements hawkish policy, interest rates could rise, strengthening the dollar and crushing gold. A stronger economy reduces safe haven demand. Technical damage from Friday's sell-off could trigger algorithmic selling and stop-loss cascades, accelerating the decline. My honest assessment? This is probably a correction, not a reversal. But corrections can be painful and drawn out. We could easily see gold fall to $4,800, $5,000 over the next few weeks before finding support. That would represent a 15-20% pullback from the highs, which is normal and healthy after a 30% monthly gain. The question is whether you have the stomach to hold through that volatility. The silver wildcard. Silver's situation is even more precarious than gold's. At $111 on Friday, silver is still up spectacularly for the month, but it's down over 8% from Thursday's record high of $121.64. Silver has a pattern of violent rallies followed by equally violent corrections. The 2011 crash, when silver fell from $50 to $28 in weeks, haunts every silver bull. If gold corrects to $5,000, silver could easily fall to $9,100, a 20-25% decline from current levels. The leverage works both ways. But the industrial demand story for silver remains compelling. Solar PV installations, EV production, 5G infrastructure, these aren't going away. Supply constraints from China's export restrictions are real. Silver could correct hard in the near term and still be in a long-term bull market. What should investors do? So what's the practical takeaway for actual investors? If you own physical gold or silver, don't panic. Friday's move is noise. If you bought gold as long-term insurance against currency debasement and geopolitical chaos, those reasons haven't changed. Hold your physical metal. If you're trading paper, gold, silver, manage risk religiously. Use stop losses. Don't over-leverage. Volatility is about to intensify, not decrease. You can be right about direction and still lose money if you're over-leveraged. If you're thinking about buying, wait for the dust to settle. Let's see where gold finds support. $5,000 or $4,800 would offer much better risk-reward than buying at $5,200 after a $1,000 monthly rally. Watch the Fed chair announcement. Trump said Friday he'd announce his pick. If it's Warsh and he signals aggressive tightening, gold could fall further short-term. If it's someone more dovish, gold could rally. Monitor physical premiums. If physical gold and silver premiums stay elevated even as paper prices fall, that's bullish. It means real buyers want metal regardless of paper price. The bigger picture. Step back from the daily noise and look at the bigger picture. Gold has now posted 6 consecutive monthly gains. That's not normal in a healthy, stable market. That's a sign of structural problems. The January 2026 gain is the strongest monthly gain since January 1980. The last time gold moved like this, the world was facing 14% inflation, an energy crisis, Cold War tensions, and a crisis of confidence in the dollar. Sound familiar? The 1980 peak was followed by a 20-year bear market as Paul Volcker hiked rates to 20% and crushed inflation. Gold fell from $850 to $250 over 2 decades. Could that happen again? It's possible, but unlikely. The U.S. can't afford 20% interest rates with $36 trillion in debt. Volcker could break inflation because debt levels were manageable. Today's debt load makes that impossible. This is why many analysts believe we're in a fundamentally different environment than the 1980s. The debt trap means central banks can't truly tighten enough to kill inflation without causing economic collapse. And that's ultimately bullish for gold long term, even if we get violent short-term corrections. The bottom line. Gold just posted a $1,000 monthly gain, the strongest since 1980. Silver surged 56%, the best monthly performance in history. Then Friday hit, Trump teased his Fed chair pick, and everything sold off. Gold fell 1.77% to $5,211. Silver dropped 2% to $111. Platinum and palladium crashed even harder. The rally was driven by geopolitical chaos, dollar weakness, central bank buying, physical demand, and Asian institutional flows. The sell-off was driven by speculation about a hawkish Fed chair and profit-taking after parabolic gains. What happens next depends on who Trump picks, how the Fed responds, whether the dollar stabilizes, and whether physical demand holds up. Short term, we could see a 10 to 20% correction. Long term, the fundamental case for gold remains intact. Unsustainable debt, geopolitical instability, currency debasement, and loss of confidence in fiat money. Friday's sell-off isn't the end of the gold bull market. It's probably just the beginning of the volatility. Buckle up. This ride is about to get even wilder. If this breakdown helped you understand the chaos, hit that like button and tell me, did you sell on Friday, or are you holding through the volatility? This has been your guide to the most volatile precious metals market in 46 years. Thanks for watching, and I'll see you in the next one.